Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host today, Thursday, July 22nd. Today we have our mid-year update, welcoming back Sam Garza, portfolio manager at DoubleLine, to walk us through what's been going on this year and what we think to expect for the rest of 2021. Sam, welcome back. Nice to see you.
Good to see you too. Thanks, Ken.
Sam's prepared some slides for us to help us guide the conversation. So I'm just going to turn it over to you, Sam, and have you tell us about what happened this year.
All right. Well, let's get started. So I think, to your point, we'll start off with a little bit of a recap on what's happened since we last spoke. It's hard to believe it's been about 6-7 months now. So I think we last spoke in mid-December. And since then, it's certainly been quite a year. We're a little over halfway through. I have on the screen right now, just taking a look at the returns from a cross-asset perspective across the board year to date. I think that's a good place to start. We have this sectioned by different large asset class. This is a chart we use regularly in our macro meetings. So off to the left are equities, stocks, then we have fixed income or bonds, we have currencies, and then we have commodities. I think the thing I would sort of just really point out is just looking at all the colors here is off to the left, equities, really healthy double-digit returns for the most part, and all the way off to the right, commodities, another area of growth. When you think about an economy growing quite strongly, I think you're going to bucket in there and assume that these two asset classes, commodities and equities, will do well. A bit more of a mixed bag in fixed income and FX. But a big takeaway here is that I think 2021 has been very much of a recovery year. We all know that. It's been quite a strong growth and inflation, as we spoke about in December. I think we were sort of right on top of it, thinking about the base effects leading to a lot of inflation to start the year off, and just the shortages and some of the other things that we see. They're usually sort of associated with a really strong economy. We'll get into that, but I think really the big takeaway here is just the strong performance of the so-called risk sectors.
Yeah, in December, what we talked about was that all the stimulus in the system, the recovery, the reopenings, we'll see growth, and we'll probably see inflation. So commodities, of course, have done well. Rates rose through at least the first part of the year, through the first quarter. A lot of the reflation trades like value and some of the cyclicals and equity market did really well. And then more recently, maybe about 30, 60 days ago, a lot of that stuff started to reverse. Rates have come down, and the theme or the market's kind of trying to figure out, is the best behind us, or are we back to kind of the secular stagflation? And maybe that's why rates have come down. So I think that's kind of the big question on everybody's mind is, what now? What's next, right?
Yeah, absolutely. We've got quite a few slides on that sort of topic. It really is the question of the day. So where are we going from now? And as we'll get into, where are rates going? Why have they we've seen this rate rally? And speaking of fixed income, so the prior slide was cross asset. We also like to look at this. I'll sort of just drill down a little bit more, if you will. And this is a chart, again, we typically look at in our macro meetings, and it's oriented from the left. So I'm not sure you can see everything, but all the way off to the left are fixed income sectors with a lot of duration, investment grade, AAA investment grade. Sectors that have less spread but have a lot more duration tend to act more treasury-like. And as we move towards the middle, we've got high yield and bank loans, so more growth oriented, less interest rate duration, if you will. And then we go through the structured finance sectors, and we end off to the right with EM. But again, I want to point out here, much like the prior slide, where the left and right side, where there was a lot of green in the center, there was a bit more of a mixed bag. Here we can see duration off to the left. Those sectors, those buckets of fixed income, there's more red. And really the highest returns that we've seen is CCC loans, CCC high yield, BBB CMBS, BB CLOs. A couple things going on here. One is I think there's a lot of catch up from 2020 and the areas that have sort of lagged. And also these are the most economically sensitive sectors, and the areas, if you had told me we're coming into a year, which I think we anticipated, of strong growth and a strong inflation, I would imagine you would see an outcome like this within fixed income. So prior slide, looking across asset classes. Here we're drilling in within fixed income, and you can again really see that the areas that are really pro-growth, pro-cyclical sectors have really sort of outperformed. And the areas with more duration, as we know, investment grade, have been sort of a lagging return.
Yeah, taking more risk definitely has been working throughout the year.
Absolutely. And you spoke of the sort of switch we had in interest rates. And I think as we sort of think about what we've seen the year to date, what we have on the screen here is the US 10-year Treasury. This is the yield from the start of the year till today. And just like clockwork, right at the end of Q1, literally on the last day of Q1 was the day that we had the highest rates for the 10-year Treasury. I think a lot of factors going in here. We're going to look at some slides of why maybe we've seen this. There's, I think, a number of different things that have happened, but it is really quite interesting how much the 10-year Treasury was rising into the end of the first quarter, and now there's just been this gentle downsloping, but from Q2 through being now in Q3. And with that, I'm going to move into some slides on the looking at inflation and growth. As you mentioned, we were really very much anticipating higher inflation this year, and that's really been a huge story this year in general. We like to sort of bucket things and think about everything in a regime state of growth and inflation when you look at the big picture for the economy. And I'm not going to go through all of this, but I just want to sort of point out what we're looking at here. We have inflation on the left-hand side, and running along the top is GDP. And it goes from the top left is the lower numbers, and as you move down, there's higher numbers. So, for example, where we are now, where the X is marking the spot, that is an area of the highest inflation and the highest growth. Now, this chart looks at data going back to 1959, and it tries to sort of bucket things together and says, depending on when you're in each of these boxes, these asset classes tend to do well. So again, I'm not going to go through all of it, but a couple takeaways here. One is we're sort of off the charts on growth. Obviously, we had a very strong Q1 and Q2. And we're also in a pretty high inflation state. Obviously, the 70s and the very early 1980s saw higher inflation, but going back now all the way to 1959, we're really in the lower right-hand box, and that tends to be over time tends to favor equities, commodities, and in this case, gold. We haven't seen that this year, but equities and commodities, just like we saw a couple slides ago. And the sectors that tend to do least good are Treasury and corporates, and we have seen that so far this year. So the mapping together the regime state of where we are has really worked well when you sort of think about the asset class. And of course, the big question is where we're heading from here. But it is interesting to see exactly where we are and where we've been this year and how that tends to play out. And it's played out just as like you would expect, again, with the exception of gold.
Yeah, and then for as long as I can remember you showing that chart in our weekly meetings, that's the first time that we've been in that bottom right-hand box.
Absolutely, yeah, it is. It's almost been a bit of a boring chart. It's a reminder of where we are, and now we're off to this bottom right-hand box, and it's really been interesting. So thinking about inflation for a minute, one of the first good places to start is looking at inflation surprise index. Now, this is a really busy chart. Just looking at the black line and noticing that is basically at new highs. And the way to think about this is Citi Global Inflation Index. And when the line is moving up, that means the data is coming in higher than even anticipated. So this isn't really sort of speaking to where inflation data is. It's really speaking to the fact that not only whatever we're going to talk about inflation, but the data is actually coming in even higher than folks thought. And I think that's certainly been the case this year with the inflation prints that we're seeing. So chart only goes back to 2010. Unfortunately, doesn't go back much further. But a starting point is we're in a state right now where inflation is surprising to the upside globally, and you can't all see all of the colors. These are major regions. All of the regions are above the zero line, which means that not only is it surprising to the upside globally, but then each of the regions like Eurozone, like, we've got BRICS broken out on here. We don't use that terminology much, but thinking about Brazil and Russia, you've got the US, we've got major economies, Latin America, there's a lot of different breakdowns by regions, and they're all flashing to the upside.
Yeah. So the big question, is it going to stay elevated or is it going to come down? That's the $1 million question right now.
Absolutely. Absolutely. And we've got, hopefully we can sort of get into that. This chart goes back to 1980. This looks at headline and core CPI. Again, thinking about what we wanted to talk about today, there's a lot of different inflation charts we could have used. I did grab probably more than normally because a lot of the charts are pretty eye-popping, but here you can see, again, we have to go back to the early 1980s to see inflation data anywhere near this. We've got headline at almost 5.4, core at 4.47. So these are really high inflation numbers, which we'll get into, but just the look of the chart just really is really eye-popping, particularly the white line, which is core, which hasn't been at this level since the early 1990s. And an interesting way to look at inflation, and I'll read the quote there from our friend Gerard Manac out of Down Under, Australia. He writes, "The fact that the Fed has promised not to be preemptive in this cycle is the single most important reason to expect a second wave of inflation." So the big debate, and we'll talk about this, is inflation transitory or not? And I think you could put Gerard in the camp that we probably will see more sustained inflation. I think there's a lot of pluses and minuses to sort of really thinking about that question, which we'll get into. Here, what we're looking at is basically the standard deviation or the volatility of inflation, and another chart where the volatility or the standard deviation or the changes of inflation has really moved up in an eye-popping way. Again, harkens back to the early 1980s. We've really been in a sustained period for almost 40 years of pretty low, stable inflation. And all that's been very quickly disrupted over the last 6 months. Again, the big question, as we'll get into, is where might we be going from here?
Yeah, I think one of the telling and interesting things happening right now is we're right in the middle of earnings. And, the economists tell us that it's transitory, but the actual business leaders, the CEOs of these companies, it seems like a lot of them are talking about that their input costs are going to remain elevated as far as they can see. And, I think it's more qualitative as opposed to quantitative, but I think it's something to take note of.
Yeah, I think that the simple answer is nobody knows right now. And we're trying to put together the pieces of a puzzle. And a lot of the pieces now are starting to really sort of beg the question, is this really looking transitory? You talked about businesses. And so here we're going to look through the first of two charts. There's a NFIB goes out and basically asks small businesses a variety of questions. And this question is revolving around what portion of small businesses think inflation is the single most important problem. And right now we're sitting at about 13%. There's lots of other problems, I would imagine, for small businesses, including labor shortages, and so on. But here you can see small business saying exactly what you described. We're seeing inflation as an issue. Really, we had that brief period back in 2007, 2008 when we had an oil spike, and a lot of people have forgotten because we went through the global financial crisis, but we actually had a pretty strong commodity cycle really culminating right before the financial crisis, really started in mid 2008. And we're back at sort of similar levels in terms of concerns by small business on inflation. Another question, and this really, I think, gets to maybe the point that you were mentioning, is thinking about business inventories. And again, another question to small businesses, what portion are sort of reporting that have inventory concerns? Now, this chart goes back, here we're looking back to the 1970s, and we're way off the charts here in terms of the inventory question being a problem. I mean, it's really sort of in no man's land. Lots going on here underneath. Obviously, we had drawdowns from 2020 in terms of inventories and what was being able to produce. Largely speaking, the global economy shut down. So a lot of things weren't made, and we were drawing down stockpiles. And now we have a variety of shortages, as we know, pretty much across the board. And we're seeing that reflected in the concern by small businesses here, which I think when you think about inventories being sort of drawn down, and if you want to go with the narrative that we're sort of in this inflation transitory sort of camp, this is probably telling you that there's going to be even when maybe growth slows down, there's going to be still be a sort of sustained amount of restocking going on by businesses.
Toilet paper we can find again.
Yes, toilet paper we can't find again, luckily. Unfortunately, chips and other things where there's a shortage of. And so I think when you look at inflation, coming into this year, we talked about some of the base effects that we thought we identified as being an issue. There's been shortages that I think are very much contributing to that, and we're seeing that reflected in used car prices. A big question will be sort of labor. We have some charts on labor, and just a really strong economy and all that is entailed in the strong economy. One of the things that has actually been more helpful for keeping inflation somewhat contained very recently, and I'm talking really over 2020, has been shelter CPI, or basically the CPI calculation for housing. And that's been coming down for a lot of reasons. But for most of the last decade, from basically the end of the financial crisis through 2019, shelter or housing inflation has been actually one of the strongest parts of the inflation calculation, really helping to sort of keep inflation elevated, if you will. But now we know that we've seen very strong housing prices, particularly as over the past year. That's the black line. The black line here is the Case-Shiller home price year over year. That's running at just under 15%. What we have on this graph here is showing that number, the Case-Shiller, with the shelter CPI year over year with a 12-month lag. So, sort of makes intuitive sense. Home prices go up a lot, and then over time that starts getting reflected in rents and shelter CPI. And so now the question is, after this really strong year of home price appreciation, will we start seeing that actually shelter CPI starts moving up? And in fact, we have seen that. You can see the blue line over the last couple months has really started to increase. You can't quite see it here, but the increase that we've seen, I think over the past month, was the highest 1 month increase since way back in 2005. So if we're going with the inflation as sort of transitory narrative, we have to put all these different pieces into our calculation. And now it's looking like shelter CPI, and certainly looking at home price appreciation, as I mentioned, that might actually be, really starting to contribute to more inflation on a go-forward basis.
Yeah, one would think today the median home price got announced. It's at the highest it's ever been. So we're hitting a new high on the median home price in the U.S. And anecdotally, we know that rents outside of, let's say, Manhattan and some of these big cities where there was this flight to the suburbs, rents in suburban areas have gone up on multifamily, and the New York, San Frans of the world, rents are starting to go up as well. So the momentum of just prices and rents is still going higher right now. So you would think that number, the CPI, shelter CPI, keeps going up, at least in the near term.
Yeah, and like I said, it's just the most recent number we have is the highest in over 15 years. So that's something to certainly think about. And speaking of that, we couldn't sort of talk about inflation without looking at sort of what the market thinks. And here we have a poll done by Deutsche Bank. This was done a couple months ago, but they asked 620 market professionals, do you think that inflation is transitory? And at least as of about 2 months ago, 2/3, this is the last poll we have, 2/3 said yes, mostly transitory. About a quarter said permanent, and then you have sort of a mix from there. So the Fed has certainly been talking about inflation being transitory. If you use this poll as a reflection of what's priced into the market thinks, for the most part, inflation is transitory. So it does seem like the surprise, if there is one, will be more sustained inflation over time. Again, as I mentioned, I don't think there's a sort of a clear answer out there. I'm probably more in the camp of, well, first of all, I have to sort of question what is transitory. If we have sustained high inflation for 2-3 years, is that considered transitory? It's really hard to say. I mean, I think I get the gist of the question is are we moving out of this low inflation regime? But I'm myself leaning more towards having a bit more inflation for longer than folks think. Certainly our own internal forecasts are showing it could very well stay elevated through 2022.
The bond market's certainly agreeing with the mostly transitory today. We'll see how that changes through time.
Yeah, that absolutely seems to be the case. And just to sort of wrap up here on the question, or at least the starting point for inflation, what we have here is the CPI forecast. The black line is actually CPI, and then the blue line is for 2021. The orange line is for 2022, and then the green line is for 2023. So here you can see the anticipation is a higher level of inflation for 2021, and then coming down pretty quickly in 2022, and then 2023 ending up at 2.2. So we just talked about the poll. Here's a look at economist forecasts. Economists are forecasting that inflation will be transitory as well. So again, the sort of consensus, although a lot of people would like to discuss it, seems to be in the market that inflation will be very short-lived, and as we move through 2022 and 2023, it's going to really be coming back down to prior trends. So that's a little bit on inflation. I thought we'd talk a little bit about growth, and particularly see where we've come and where we might be headed. Another chart like the previous one, there's a lot of lines on here. We like to look at this chart because I think it's really telling. These are economist forecasts for different quarters of growth in the US for GDP. So all the way at the top, the yellow line is for Q2. We just ended Q2 about 2-3 weeks ago. And the anticipation there now is about 9% GDP. It peaked as high as 10%. That's a really, really high number. Obviously, that's the highest number by far of most people's careers. And then we have Q3, the green line, coming down to 7%. And then as we move to Q4, we're down to 5%. All of these numbers are pretty high levels of GDP, particularly compared to what we've been in for the last almost 2 decades. And I think there's a really important point here when you look at the yellow and the green line. And that is that growth should be slowing if we realize what expectations are. So there's like this second derivative effect of slowing going on, but we're still at really high levels. So we're going from 9, if these forecasts turn out to be accurate, we're going from 9 to 7%. That is a substantial slowing, but even the 7% would be a fantastically high number for any time period in the past 20 years. So I think, keeping this in mind as well, we're going through this sort of deceleration, but it's from really, really high levels. Of course, these forecasts may not turn out to be accurate, but just taking them at face value, it's still pretty strong growth, at least even through Q1 2022. Again, if these turn out to be accurate.
Yeah, one could even say that the bond market thinks that the slowdown is going to happen faster than these economist predictions.
Yeah, I think that's the case. I'm just reading an article this morning, and the headline was "Growth Scare," and sort of talking about some of the reasons why we might be seeing that slowdown in interest rates, and that is certainly a possibility. I built a little bit of a section on rates, which we can certainly dive into, but the growth scare component is certainly one of those. We're going to look at a couple high-frequency fund charts that we look at in our macro meetings now. We never looked at these pre-pandemic, but I think they're really sort of telling about what's going on within the economy. OpenTable, of course, is the app where we all would make reservations to dine in. And here's a look at OpenTable reservations. These are the changes from 2019, so pre-pandemic. We're running right now down about 4.7% versus 2019. So pretty close to back to pre-pandemic levels. And we got, this was as low as down 100%, of course, during the real lows of the pandemic last year. And you can see how this has sort of continued to sort of increase to where we are now, which is just about flat with 2019.
Taking a look, that number may come down with this kind of like fourth wave that we're kind of seeing globally. People might stop, slow down some of their activities.
Yeah, I think a lot of that will probably depend on what the government does in terms of restrictions. So far, we haven't seen in the U.S. Any that I'm aware of any economic shutdowns. We've seen mask mandates, but so far it feels like a lot of the politicians are really hesitant to create any sort of economic shutdowns at this point. We'll have to see what happens. Yeah. And similarly with this is TSA traveler data. Again, the yellow line is 2021. That's this year. The green line is 2019, so pre-pandemic. And we've got 2020 on there, which again was a very slow year for travel. We're still running about, looks like about 400,000 per day fewer than we were in 2019. I think a big part of this is that a lot of international travel is still shut down.
Absolutely.
It feels like domestic travel is going pretty gangbusters right now, at least in terms of the vacation side. And another thing to sort of keep in mind here is usually in September, you have a handoff from leisure travel to business travel. And I will be very interested to see what happens with leisure travel, fourth wave notwithstanding, just in general. We're talking by Zoom now, where in previous iterations of the world, we would be doing meetings, or a lot of this is sort of going on. So what happens come September with travel? I would sort of bet now that we'll see a bigger delta or a bigger decrease versus 2019 as we sort of move into the more of the business travel. I still think business travel is going to, at this point, I think business travel is going to be a lot stronger than we've seen in the last 18 months. It's just that we don't know how much less it will be versus 2019.
Sure. I did see in Vegas has been doing really well, and so we're going to have some conference that was going to be offered virtually to anyone that wanted to go. And I think over 90% of the people wanted to attend in person. Now maybe part of that's pent up demand, and through time that dwindles, but it sure seems like people want to kind of get back on the road and get back out there and try to normalize things.
I think that's absolutely the case, and I heard that same story. It's a nice sort of segue to hotel occupancy, another high frequency. What's going on in the economy chart? The red line here is 2021, so that's this year, and the solid blue line is the median from 2000 to 2020. I mean, we're in terms of hotel occupancy, at least at the very high level. I mean, we're running like maybe 1 or 2% below where we were from 2000 to 2020. Now the dotted looks like a purple line there is 2019. 2019 was a pretty hot year in terms of the economy, or at least business travel. But versus the median, we're right there. And so this is, I look at a chart like this, and I can sort of, this sort of really matches well with the story you were just talking about with Vegas. Okay, so just a lot of charts again, as I mentioned, we really have to go back to the early 1980s to sort of compare to. This is looking at our forecast for nominal GDP this year. So what we're doing here is we're looking at the Bloomberg economist forecast, which I mentioned, and we come up with our own inflation forecast here at DoubleLine. And when you put those both together, inflation and growth, you come up with nominal GDP. We're looking at possibly 11.7% nominal GDP this year. Really, you have to go back to 1981 to see something that high. So the magnitude of what's going on in the economy and inflation is really, again, for most people's career, financial career, you're really not seeing anything like this, and you have to go back to 1981 to sort of put a similar number on the board.
Well, one would hope after all the stimulus that we pumped into the financial system that we would see numbers like this. If we didn't see numbers like this, then that would be quite alarming.
Yeah, I think that's a good point. That would mean that the hole that you're filling in the ground, you're not putting in enough dirt to even sort of just keep flat. You're sort of still just putting money into a sinkhole. So the economy, nominal GDP we're now recovered, and at least on paper, nominal GDP is now at new highs. I don't have that chart here, but what we are looking at here is we're at new levels of highs in nominal GDP, but we're still running about 6.7 million or fewer workers than we were pre-pandemic. And when you put those together, you get a chart like this, and this is just the ratio of nominal GDP to total employment. I think there's a lot you could sort of read into this. You could say we're running a lot more productive economy these days because we're able to run nominal GDP at a higher level with fewer workers. And when I go around and see the levels of automation, I certainly see anecdotes of this. I always tell the story, but now going to the local airport parking lot, it's all finally been automated. And where there was once a couple dozen workers, now there's one guy just making sure that everyone puts their credit card in correctly, and that parking lot's completely full. So just that one little anecdote, there is just absolutely more productivity there. Another spin on this might be, well, as you mentioned, we've dumped so much stimulus that the GDP numbers are going up, and we're just paying people to stay home and et cetera. I think that the real, for me at least, the answer is somewhere in between. I do think there's been a high level of productivity, however you want to define it, but just in simple terms, there's been a high level of productivity sort of injected into our economy that we're not going to really start noticing for a while. It's things like automation. It's the medical technology innovation that we've seen. doing calls with physicians and doctor calls and all that, not getting on the road. I mean, that just creates more efficiency all around. And I think that will probably end up paying dividends for a while, but will be really difficult to see, particularly in a pandemic where there's so many moving parts and there's so much ebb and flow of different data and distortions and whatnot. But it's an interesting possibility.
Well, that last chart you had up, the kind of like what percentage of the population is looking for employment. That's kind of the chart that deflationistas are pointing to. And I feel like that's what Powell talks about a lot when he says we still have, considerable work to do to kind of get the economy back to where it was. Is there's still a lot of the population that was working, that's not, and that's that slack in the labor market. And to get sustained inflation, we need that slack to go away. And that's kind of the bull case, I guess, for bonds, and the deflationary case is that, combination of that slack along with the things you talked about, the secular stagnation case, right? Technology, demographics, that we're going to kind of go back to that low growth environment. So I feel like that's a really important chart to watch, is kind of what's going on with, US employment to population ratio.
Yeah, absolutely. And watching what's going on with wages, again, wage growth and the, when you ask small businesses, there's a lot of angst about not being able to hire enough employees, and they're planning to raise wages. And so, going back to sort of Gerard Manac in that same piece with the quote, he's really talking about the real thing that, real sort of thing to be watching is wage growth. And does that really translate into sustained higher levels? And that will mean that we're moving into a higher inflation state. I think there's a lot of factors out there. If you want to sort of think about lower or disinflation, there's demographics, there's technology, there's where we are that you just mentioned, and thinking about the employment to population ratio. And when you want to think about inflation, there's, well, at least in the near term, there's the shortages that we've been highlighting, and that's been, sort of well documented. And there's something else that we kind of forgot about because it's been lost in this huge event called the pandemic over the last 18 months. And that is the fact that maybe we're sort of peaking out on some globalization for most of the 2000s through the 2010s. China was effectively, exporting a lot of deflation by being integrated into the global economy. And so, US multinationals, for example, were benefiting from cheaper labor by outsourcing to China, and that would bring down their costs. And you saw an explosion of profits. And I think now we're moving more, it's far more questionable about where we're sort of headed with that. I think, we were talking about this yesterday in an internal call at DoubleLine, and geopolitics is really something to sort of be focused on. And it certainly seems, even with the transition to a new administration, the sort of friction with China is not going away. And, the trade deficit with China is still quite high, but I can see scenarios where these frictions and tariffs remain in place, and that may not be sort of suppressing inflation, may ultimately end up, sort of lifting inflation to the extent trade wars and other factors like that come into play. And that's certainly another thing that we need to watch.
Yeah, that's a really good point.